You want to know how to hold trades without stress. That's a fine question, and the right one. Because the truth is, most men don't lose money because they cannot read a chart. They lose because they cannot sit still while the market works. Now let me tell you something plainly. The market does not pay you for activity. It pays you for patience. I learned that lesson the hard way, and if you trade long enough, you will too. The ticker can tempt a man into doing foolish things. It whispers. It shakes. It makes you feel as though you must act this very minute. But the big money, the real money, comes from sitting tight once you are right. Have you ever noticed how calm the market looks right before it makes its real move? Most traders miss it because they are too busy watching every tick as if their life depends on it. Stress comes from uncertainty, yes, but more often it comes from being in a trade you don't truly believe in. If your entry was careless, your exit will be nervous. That is the first principle. A man who has done his homework, who has studied the trend, who has waited for the proper setup. That man sleeps better at night, not because the market owes him anything. It never does. But because he knows he acted according to a sound plan. So ask yourself honestly, did you enter the trade with a clear reason, or did you enter because the candles were moving fast and your fingers got itchy? Be truthful with yourself. The market always knows when you're guessing. Now, when it comes to holding trades without stress, you must first understand the nature of price movement. Markets do not move in straight lines. They advance, they pause, they shake out the weak hands. This is normal. This is necessary. Yet what does the average trader do? He buys the breakout, then panics at the first pullback. He sells the breakdown, then sweats at the first bounce. Tell me, how can a man expect peace of mind if he does not understand the rhythm of the market he is trading? You must train your eye to see the difference between noise and real danger. A healthy trend breathes. It moves forward, pulls back, and then continues. If you cannot tolerate that breathing room, you will always feel pressure while holding trades. This is why position sizing is not just mathematics. It is psychology. When your position is too large for your account, every tick feels personal. Your heart starts racing. You check the chart every minute. You begin imagining losses that haven't happened. And then, as I have seen thousands of times, you exit a perfectly good trade only to watch it move exactly where you first expected. Does that sound familiar? The cure is simple, though not always easy. Trade small enough that you can think clearly. A trader who is overexposed cannot be objective. He is no longer reading the market. He is reacting to his own fear. I have always believed that the market punishes emotional excess. It rewards the cool, headed operator who waits for the right conditions and then gives the trade room to work. But let me caution you here, holding without stress does not mean holding blindly. There is a difference, a very important one, between patience and stubbornness. Patience says, my trade thesis is still valid. The trend structure remains intact. Stubbornness says, I refuse to admit I might be wrong. Which one are you practicing? This is where chart reading becomes your compass. Before you enter any position, you must already know where the trade is proven wrong. Not guessed. Not hoped, known. When you have a predefined invalidation level, something remarkable happens. The trade stops feeling like a gamble and starts feeling like a business decision. You either hit your level or you don't. And because of that clarity, your mind stays quieter while the trade develops. You see, stress feeds on vagueness. It thrives when you are unsure. The professional trader removes as much uncertainty as possible before the trade ever begins. Another thing the public often misunderstands is time. They want the market to move immediately after entry. They watch the clock. They measure every candle. But the market moves on its own schedule, not yours and certainly not mine. Have you ever entered a solid setup only to grow impatient after a few quiet hours or days? Impatience is one of the costliest habits in this business. The market often tests your conviction before it rewards it. It will drift sideways. It will fake out weak holders. It will do everything in its power to make you question your position. That is not a bug in the system. That is the system. The man who understands this does not fight the waiting period. He expects it. Now let's talk about mindset, because without the proper mental framework, no amount of chart skill will save you. You must stop thinking of each trade as a verdict on your intelligence. Too many traders take every fluctuation personally. Price goes against them by a few points and suddenly their confidence evaporates. Why? Because they are emotionally invested in being right. But trading is not about being right all the time. It is about managing risk and positioning yourself alongside the dominant trend. Enter only when your chart gives you a clear, logical reason. Uncertainty at entry creates stress during the hold. That is not theory. That is the plain truth of speculation. I have watched countless traders suffer, not because the market was cruel, but because they stepped into trades without a firm reason for being there in the first place. You see, the moment you enter on a weak premise, your mind knows it. Even if you try to ignore it, the human mind is sharper than most traders give it credit for. It remembers whether you acted with discipline or with impulse. And when the market begins to wiggle, as it always does, that buried doubt rises to the surface. Have you ever noticed how a trade feels different when you know exactly why you took it? When your chart shows a clean trend, a proper consolidation, a breakout backed by volume, there is a certain calm in the decision. You are not guessing. You are not hoping. You are acting on evidence the market itself has provided. But when you jump in because the candles look exciting or because you fear missing the move, something inside you remains unsettled. And that is where stress is born. The market does not punish uncertainty directly. It simply exposes it. A man who enters without a logical setup begins managing the trade emotionally instead of analytically. Every small pullback feels like danger. Every pause feels like failure. He starts watching the chart too closely, looking for reassurance the market never promised to give. Now think carefully. Why does this happen? Because without a clear reason for entry, there is no anchor for your confidence. You are floating. And a floating trader cannot hold steady when price begins to fluctuate. Professional operators, the ones who last in this business, build their positions on structure. They study the trend. They wait for price to behave in a recognizable way. They let the market show its hand first. This waiting is not laziness. It is preparation. When you wait for a proper setup, you are doing more than finding a good trade. You are buying peace of mind for the holding period that follows. Because once you are in the position, the real test begins. Not of your chart skills, but of your composure. Let me ask you something plainly. If someone woke you at midnight and asked why you are in your current trade, could you explain it in one calm sentence? If you cannot, you are already in a weak position psychologically. The best trades, the ones you can hold without sweating, usually share certain characteristics. The trend is clear on the higher time frame. The entry occurs at a logical point, not in the middle of nowhere. Volume or momentum confirms participation. And most importantly, the risk level is defined before the order is ever placed. Notice what is happening here. Clarity at entry removes noise during the hold. Most traders try to manage stress after they are already in the trade. That is backward thinking. Stress is largely determined at the moment of entry. If the foundation is shaky, no amount of positive thinking will steady the structure later. Another mistake I have seen repeatedly is the habit of chasing price. The market starts moving fast, and suddenly discipline disappears. The trader tells himself, "I'll just take a small position," or "I don't want to miss this move." But the chart has not given permission yet. When you chase like this, you are entering someone else's trade late in the game. Your stop must be wider, your confidence weaker, and your stress higher. The professionals, meanwhile, are often using that excitement to lighten their positions. Does that give you something to think about? The calm holder is usually the early, prepared trader, not the late, emotional one. You must train yourself to treat entries like a surgeon treats an incision. Precise, intentional, never rushed. The market opens every day. Opportunities repeat, but your capital and your mental energy are limited resources. Guard them. There is also the matter of expectation. When you enter with a clear chart-based reason, your expectations become realistic. You understand where the trade should work and where it should fail. This keeps your thinking grounded in market structure rather than wishful thinking. Without that structure, the mind begins to invent stories. You start hoping instead of observing. And hope in speculation is a very expensive habit. The steady trader does not hope. He prepares, executes, and then observes what the market does next. If the trade behaves properly, he sits tight. If it violates the premise, he exits without drama. All of this discipline begins before the first dollar is committed. Because the truth is simple and often overlooked. The quality of your holding experience is decided at the moment you choose to enter. Define your invalidation level before you enter. A trader without an exit plan cannot sit calmly. That is not a clever saying. That is survival in this business. The market has a way of exposing every loose end in a man's thinking, and nothing is looser than a trade with no clear point of being wrong. Most traders spend all their time searching for the perfect entry. They study indicators. They draw lines. They wait for the signal that feels just right. But very few of them pause long enough to ask the question that matters more than all the rest. Where am I wrong? Have you ever noticed how uncomfortable a trade feels when you don't know the answer to that simple question? The mind begins to wander. Every tick feels suspicious. Every pullback looks dangerous. You start negotiating with the market in your head. Maybe I'll give it a little more room. Maybe it will turn back. That is not trading. That is hoping with money on the table. The professional operator does something different. Before he ever clicks the button, he already knows the exact price level that proves his idea invalid. Not approximately, not emotionally, precisely. Because once that level is defined, something important happens inside the trader's mind. The uncertainty shrinks. The boundaries become clear. The trade becomes a calculated business decision instead of an open-ended worry. You see, stress thrives in the unknown. If you enter a trade without an invalidation level, your risk is not defined. It is floating, and a floating risk is what keeps traders glued to their screens, watching every candle as if they could control the outcome by staring hard enough. But the market does not respond to your attention. It responds only to supply and demand. When you predefine your exit point, you are doing more than managing risk. You are protecting your mental capital. Because now, instead of reacting emotionally to every small move, you have a clear line in the sand. Either the trade respects your premise, or it doesn't. Let me ask you something directly. When price moves against your position, do you feel the urge to widen your stop? Be honest. Many traders do. That urge is a symptom. It tells you the invalidation level was never truly accepted in the first place. The trader may have written it down, but deep inside, he had already decided he didn't want to be wrong, and the market has very little patience for that kind of thinking. The disciplined speculator understands that being wrong is part of the business. Losses are not personal failures. They are operating expenses. When you truly accept this, setting an invalidation level becomes easier, and holding trades becomes calmer. Because now you are not fighting uncertainty. You have already measured it. There is another advantage here that many overlook. A proper invalidation level helps you size your position correctly. Without it, position sizing becomes guesswork. And when position size is wrong, emotional pressure follows like night follows day. Have you ever been in a trade where the position felt just a little too large? Every tick suddenly matters more than it should. Your breathing changes. You check the chart repeatedly. That is not because the market is unusually volatile. It is because your risk was never properly defined. The calm trader works in reverse order. First, he identifies the setup. Second, he determines the exact price that invalidates the setup. Third, he sizes the position so that if that level is hit, the loss is acceptable. Only then does he enter. Notice the difference in sequence. Most traders jump straight from idea to execution. The professional builds a structure first, and that structure is what allows him to sit quietly while the market does its work. Now, this does not mean the trade will always behave smoothly. Markets breathe. They probe levels. They test conviction. Even the best setups will sometimes move uncomfortably close to your stop before turning in your favor. But here is the key distinction. The prepared trader expects this possibility. The unprepared trader fears it. When you know exactly where you are wrong, temporary discomfort does not shake you as easily. You are no longer reacting to every small fluctuation. You are watching to see whether the market truly breaks your level. That is a very different psychological experience. Another mistake worth mentioning is placing invalidation levels based on how much money one is willing to lose rather than what the chart structure actually says. The market does not care about your comfort zone. It moves according to its own logic. If your stop sits in the middle of normal market noise, you will be shaken out repeatedly, and each time that happens, your confidence erodes a little more. The better approach is to let the chart define the point of failure. Structure first, risk adjustment second. This keeps your decision grounded in market reality rather than personal preference. Think of it this way. Your invalidation level is the market's way of telling you your read was wrong. Until that level is touched, the trade is simply fluctuating within expectation. And when you truly accept that framework, something inside you begins to quiet down while the position is open. Learn the difference between a healthy pullback and true trend failure on the chart. If you grasp this one lesson deeply, you will remove a great deal of unnecessary strain from your trading life. Most of the worry traders feel while holding positions comes from misreading normal market behavior as danger. The market, by its nature, does not move straight up or straight down. It advances, then it retreats. It gathers strength, then it pauses. This ebb and flow is the very heartbeat of a trend. Yet the average trader sees every counter move as a threat. Have you ever watched a trade move nicely in your favor, only to feel your stomach tighten the moment price pulls back a little? That reaction is common and costly, because more often than not, what looks frightening in the moment is simply the market breathing. A healthy trend must shake out weak holders along the way. It must test conviction. It must create doubt. Without that process, trends would run too smoothly and everyone would profit too easily. The market has never been in the business of making things easy. The skilled trader studies structure. He asks simple, practical questions. Is the trend still making higher highs and higher lows? Is the pullback occurring on lighter volume? Is price respecting key support or resistance areas? These are not complicated ideas, but they require patience and clear thinking. A healthy pullback usually has certain characteristics. It tends to be orderly rather than chaotic. Price retraces part of the previous move, but does not destroy the overall structure. Momentum cools, but it does not collapse entirely. The market pauses, digests its gains, and prepares for the next leg. Trend failure, on the other hand, leaves different footprints. The structure begins to break. Support levels that should hold start giving way. Momentum shifts sharply. Volume may expand against the trend rather than with it. The character of the price action changes. Can you see the difference when you look at your charts, or do all pullbacks feel the same when money is on the line? This is where many traders lose their composure. They have not trained their eyes to recognize normal behavior. So when price pulls back, as it naturally must, they assume something is wrong. Their confidence weakens. Their hands grow restless. And then they do the one thing the market quietly encourages them to do. They exit too early. I have seen traders capture the entry perfectly, only to abandon the position at the first routine retracement. Later, they watch the market continue in the original direction without them. It is not a pleasant experience, and it often leads to revenge trading, which only deepens the problem. Understanding pullbacks is not about prediction. It is about context. When you view price movement within the broader trend structure, the smaller fluctuations lose much of their emotional weight. You begin to see the market as a series of waves rather than a collection of random threats. But let me caution you, not every pullback is healthy. Some are the early signs of real trouble. The art lies in learning to tell them apart without overreacting. One useful habit is to step back to the higher time frame. The lower time frame often magnifies noise and creates unnecessary urgency. The higher time frame tends to reveal whether the trend structure is truly changing or merely pausing. Have you noticed how a frightening 5-minute candle often looks insignificant on the daily chart? Perspective matters in speculation. Another important factor is location. Where the pullback occurs tells you a great deal. A retracement into a prior support zone within a strong uptrend is often normal behavior, but a sharp break below a well-established structural level deserves attention. The calm trader does not react to motion alone. He reacts to meaningful violations of structure. Volume can also provide clues. In many healthy pullbacks, participation dries up. The move against the trend lacks urgency. But when you see aggressive volume pushing firmly against your position, that is information worth respecting. Still, the goal is not to become jumpy. The goal is to become observant. There is a subtle but critical difference between the two. The jumpy trader watches every candle with suspicion. The observant trader watches the overall behavior of the market. One reacts emotionally. The other evaluates objectively. Which one are you most of the time? Your ability to hold trades without stress depends heavily on this distinction. If every normal retracement feels like danger, you will never sit comfortably in a trending market. You will always feel the urge to interfere. And interference, more often than not, reduces profits. The market rewards the trader who can tolerate normal movement while remaining alert to genuine change. That balance does not come from memorizing indicators. It comes from screen time, study, and honest review of your past trades. Look back at your history. How many times did you exit a position during what later proved to be a routine pullback? How many times did fear of losing open profit push you out too soon? These questions are not meant to criticize you. They are meant to sharpen your awareness. Because once you begin to recognize the true character of healthy pullbacks, something important begins to shift inside your trading mindset. Size your position small enough that normal market noise does not disturb your thinking. If there is one habit that separates the calm operator from the nervous speculator, it is this one. Position size is not just a matter of arithmetic. It is the lever that controls your emotional temperature while the trade is alive. Most traders do not appreciate this until the market teaches them the expensive way. They believe the secret lies in finding better entries, sharper indicators, faster signals. But time and again I have seen capable chart readers come undone simply because they traded too large for their temperament. Have you ever been in a trade that looked perfectly fine on the chart, yet your pulse was racing anyway? That is rarely a chart problem. That is usually a size problem. When your position is too heavy relative to your account, every tick begins to feel personal. A small pullback that should be routine suddenly feels threatening. You find yourself watching the screen more often than you intended. You start calculating profit and loss every few minutes. Your focus shifts away from market structure and toward your floating money, and that is where judgment begins to suffer. The market has a peculiar way of punishing emotional pressure. When a man feels squeezed, he tends to act prematurely. He cuts winners short. He moves stops impulsively. He interferes with trades that would have worked if left alone, all because the size was wrong. The steady trader approaches the matter differently. Before he thinks about potential profit, he asks a simpler question. If this trade moves normally against me, will I remain clear-headed? Notice the wording, normally. Markets fluctuate. Even the best setups rarely move straight from entry to target. There will be noise. There will be retracements. If your position is so large that ordinary fluctuation disturbs your thinking, you have already placed yourself at a disadvantage. Let me put it plainly. If you cannot sit quietly while the trade develops, you are trading too big. This is not about being timid. It is about being practical. The market offers endless opportunities, but your mental capital is limited. Once your emotions become tangled in a position, objectivity begins to fade, and without objectivity, chart reading loses its edge. Many traders resist smaller sizing because they are focused on fast growth. They want meaningful profit from every move. They calculate what the trade could return at maximum size and feel dissatisfied with anything less. But this line of thinking often leads to inconsistent results. Because the first duty of a speculator is not to make the maximum possible profit. It is to stay in the game long enough for skill and experience to compound. Have you noticed how the professionals often appear almost bored while holding positions? There is a reason for that. They size their trades so that the market's normal back and forth does not disturb their judgment. They are not indifferent to risk. Quite the opposite. They respect it enough to keep it within tolerable bounds. This gives them something many traders never achieve: staying power. When your size is appropriate, you gain the freedom to observe rather than react. Price can fluctuate without triggering anxiety. You can evaluate whether the trend structure is intact instead of worrying about every minor drawdown. That mental space is valuable, more valuable than most beginners realize. Another important point is consistency. Wild swings in position size often produce wild swings in emotional state. One trade feels manageable, the next feels overwhelming. This inconsistency makes it very difficult to build disciplined habits. The seasoned operator keeps his sizing methodical, predictable, boring even, because boring decisions tend to produce stable behavior. Now let us talk about the temptation to press. When confidence is high, every trader feels it sooner or later. A few good trades come along, the account grows, and the urge appears. This time I will go bigger. Sometimes that works, briefly, but the market has a long memory for overconfidence. When you suddenly increase size beyond what your psychology is accustomed to, the emotional impact multiplies. Even if the chart setup is sound, your ability to hold through normal volatility weakens. You start managing the trade differently, often without realizing it. Does this sound familiar? You may think you are trading the same strategy, but in truth the game has changed because your emotional exposure has changed. The calm trader respects gradual progression. He increases size slowly, only as his account and his psychological tolerance both expand. He understands that comfort with size must be earned through experience, not forced through ambition. There is also a quieter benefit to proper sizing that many overlook. It protects your decision-making after the trade is placed. When the position is manageable, you can follow your plan with far less internal resistance. Your predefined stop feels acceptable. Your patience lasts longer. Your analysis remains clearer. But when size is excessive, even good plans begin to unravel under pressure. You start bargaining with the market. You start second, guessing your levels. You start hoping instead of observing. And hope, as I have said before, is an expensive companion in speculation. So the practical question becomes one every trader must answer honestly. Is your current position size allowing you to think clearly while the market moves against you, even briefly?